Hello everyone, and welcome back to our channel. In today's video, we'll learn about the basics of the share market, how it works and other necessary details associated with it. So, let's start without wasting any time. A stock market is a place where you can buy and sell shares of different companies. The stock market and share market are the same thing. These are markets where you can buy or sell a company's shares. Buying shares of a company means buying some percentage of ownership of that company. That is, you become a percentage shareholder of that company. If that company makes a profit, some percentage of that profit would also be given to you. If that company incurs a loss, a percentage of that loss would also be borne by you. Telling you an example of this on the smallest scale, presume you have to establish a startup. And you have 10,000 rupees, but that's not enough. So, you go to your friend and tell him to invest another 10,000 rupees and offer him a 50-50 partnership. So, whatever your company profits in the future, 50% of it would be yours. 50% of it would be your friend's. In this case, you've given 50% of the shares to your friend in this company. The same thing happens on a larger scale in the stock market. The only difference is, instead of going to your friend, you go to the entire world and invite them to buy shares in your company. The origin of share markets dates to around 400 years ago. Around the 1600s, there was a Dutch East India Company, like the British East India Company. In those times, people used to indulge in a lot of exploration using ships. The entire world map had not yet been discovered. So the companies used to send their ships to discover new lands and trade with faraway places. The journey used to be over thousands of miles aboard a ship. There was a huge amount of money required for this. Not one person possessed such amounts of money individually in those times. So they publicly invited people to invest money in their ships. When these ships would travel long distances to go to other lands and come back with treasures from there, they were promised a share of these treasures or money eventually. But this was a very risky affair, because during those times, more than half of the ships failed to come back. They either got lost or broke down, or got looted. So there was a lot of danger. Investors realized the risky nature of this enterprise. So instead of investing in a single ship, they preferred to invest in 5 to 6 of them, so that at least one of them had a chance of coming back. One ship used to approach multiple investors for money. So this created somewhat of a share market. There were open biddings of the ships on their docks. Docks are the places where the ships come out from. Gradually, this system became successful because of the money crunch faced by the companies. Was supplemented by the common people. And the common people got a chance to earn more money. You must have read in the history books about how rich the English East India Company and the Dutch East India Company became during those times. Today, each country has its own stock exchange. And every country has become greatly dependent upon the stock market. The stock exchange is that place, that market where people buy and sell shares of the companies. The market can be divided into two types: the primary market and the secondary market. The primary market is where the companies sell their shares for the first time to raise capital. The companies decide what exactly would be their share prices. Although there are some regulations in this too. The companies cannot maneuver too much because a lot of it depends upon the demand. How much price are the people willing to pay for the company's shares? If the value of the company is 1 lakh rupees, it sells 1 lakh of its shares and offers shares at 1 rupee per share. If its demand is high and a lot of people want to buy its shares, the company would be able to sell its shares for a higher price. What companies do nowadays is decide upon a range. There's a minimum price and a maximum price. They decide to sell their shares within that range. A point to be noted here is that every share of the company has equal value. It is upon the company to decide how many of its shares it wants to make. If the total value of the company is 1 lakh, then it may make 1 lakh shares of 1 rupee each. Or it may make 2 lakh shares of 50 paise each. When companies sell their shares in the share market, it never sells 100% of them. The owner always retains the majority of the shares to keep possession of his decision-making power. If you sell the majority of the shares, and someone else becomes the majority shareholder, then you will not have the decision-making power anymore. The individual who has more than 50% of the shares would be able to make decisions regarding the company. Therefore, the founders of the company prefer to retain more than 50% of the shares. The people who have bought shares of the company can sell them to other people at the current market price. This is called secondary market, where people buy and sell shares amongst themselves and trade in shares. In the primary market, the companies set the prices of their shares. But the companies cannot control the prices of their shares in the secondary market. The share prices fluctuate depending on the demand and supply of the shares. So the prices of the shares fluctuate depending on the demand and supply. Almost every big country has its own stock exchange. There are 2 popular stock exchanges in India. One is the Bombay Stock Exchange or BSE, which has around 5,300 registered companies. The other is the National Stock Exchange or NSE, which has more than 2,100 registered companies. With so many countries registered on the stock exchange, if we want to observe, overall, whether the prices of the shares of the companies are moving up or down, how do we view this? To measure this, there are 2 indexes, Sensex and Nifty. Sensex shows the average trend in performance of the top 30 companies of the Bombay Stock Exchange, averaging out whether the shares of the companies are moving up or down. There is another similar index, Nifty 50. Similar to Sensex, Nifty 50 shows the price fluctuations of the shares of the top 50 companies listed on the National Stock Exchange. Now let's understand what IPO is. If a company is selling its shares for the first time, then it is called IPO, initial public offering. That is, offering the shares to the public for the first time, and this is done in the primary market. During the days of the East India Company, it was very easier to get this done. Anyone could sell the shares of their company to the public. But today, this procedure is very long and complicated, and so it should be. Because, think about it, how easy it is to scam people. Anyone could get listed on the stock exchange with a fake company and exaggerate the value and achievements of its company. They could lie to the people and the people would foolishly invest in his company. He then could abscond with the money. So it is extremely easy to scam people. India in its history has been a witness to a lot of scams like these. For example, the Harshad Mehta scam, the Satyam scam. They were all the same, fooling the people and getting themselves listed on the stock exchange, collecting the money and then absconding. So as and when these scams happened, the stock exchanges realized that they need to make their procedures stronger and scam-proof. For this, resolutions and rules were made stronger, due to which there are very complicated rules today. SEBI, Securities and Exchange Board of India, is a regulatory body that looks into issues like which companies should be listed on the stock exchange and whether it is being done in a proper manner or not. If you want to get your company listed on the stock exchange, then you would have to fulfill the norms of SEBI. Their norms are very strict. For example, there need to be a lot of checks and balances on the accounting of your company. At least 2 auditors must have checked your company's accounting. This entire process maybe takes around 3 years. More than 50 shareholders should be present in the company if you want a company to be publicly listed. When you go to sell their shares, but if there's no demand for it amongst people, then SEBI can remove your company from the stock market list. Now, let's understand how can you invest money in the stock markets. During the times of the East India Company, one could go to the docks where the ships departed from and indulge in biddings, and buy and sell stocks. Before the dawn of the internet, one had to physically go to the Bombay Stock Exchange building to do this. However, with the internet in place, you merely need three things: a bank account, a trading account, and a demat account. A bank account because you would need your money. A trading account to allow you to trade and invest money in a company. And a demat account to store the stocks that you buy in a digital form. People like us would be called retail investors, that is, common people who want to invest in the stock market. A retail investor always requires a broker. A broker is someone who brings together the buyer and seller. For us, our brokers could be any traditional or discount broking company, banks or a third-party app, or even a platform. For example, Angel One Limited is a very reputed broking house in India. I have shared a demat trading account opening link in the description. You can open a demat account in 5 to 15 minutes, add funds and start investing. When we invest money through brokers in the stock market, a broker retains some money as his commission. This is called the brokerage rate. Now let's understand the difference between trading and investing. So, investing and trading are two different things. Investing means putting in some amount of money in the stock market and letting it stay there for some time. It can be short-term as well as long-term. Investing period of less than 1 year is called short-term investing, and investing period of more than 1 year is called long-term investing. Fundamental analysis is needed for investing. Trading means buying and selling of securities mostly within a day, but it can be for a period of more than 1 day also. Technical analysis is needed for trading. In fact, trading of shares is a job in itself. There are a lot of people in our country who are traders and do this job all day long, taking out money from one share and putting it in another. An important question that arises is what should be the approach for beginners before entering the stock market. A lot of people compare it with gambling because a lot of risk is involved in it. In my opinion, it is correct to say so because this is indeed some sort of gambling if you are not aware of the type of the company and its performance, its financial record, and what parameters are required for analysis. If you don't observe the company's history and accounting information, then in a way, this is akin to gambling. But if proper analysis is done before investing, then definitely it's not gambling because there are a lot of people in this market who have earned enormous amounts of money with almost little or no capital by investing with proper analysis. The stock market is a place where you can earn a lot of money if you're disciplined, but it is also a place that can take all your money away if you are not disciplined. It is always better to start with investing than trading, as trading is highly risky. Investing in a portfolio of stocks is safer than investing all your money in a single stock as it minimizes the risk. This principle is used by all mutual fund companies for safety, as it reduces the risks. Thank you all for watching. I hope this video helped you understand the basics of the share market. If you found it informative, please like and share. Don't forget to subscribe to our channel for more educational content. Until next time, happy investing.